Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities. This is a big week for tech earnings. So the major companies report on Tuesday and Thursday. So that's a critical data point for the overall market. It comprises such a large amount of the overall market itself. So critical data point coming. The Federal Reserve also meets on Wednesday. They're not going to do anything, but their body language of what they intend to do this year is going to be critical. So, how to take advantage of this? The tech earnings, here are the five key companies that report this week: AMD, Google, Microsoft, Amazon, and Apple. There's a cardinal rule, or maybe just a rule, I should say, that if you're trading below one times your growth rate, so your PE is less than your growth rate, then there's value in your stock. But if it's trading at a higher multiple than your growth rate, obviously it's less attractive. And at two times, we consider that not attractive at all. And some of these companies are trading well above two times their growth rate in terms of their PE multiple. So if it's a company that's really predictable, 1.5 times is acceptable. Like a consumer staples company that they really never miss. Technology is an area that you do have surprises, both positive and negative. Looking at each of these companies, AMD's trading at 59 times earnings. So it has some of the NVIDIA hype in that stock. So I would be very cautious about this particular stock. Google, we love Google. At 23 times, it's a little higher than its average of late. However, there's still good value in it. We think that this is probably one of the best earnings business models we've seen. Microsoft at almost 34 times earnings. They're really well positioned. They're doing great. However, that multiple over the long term is really stretched. So the earnings are expected to be up 19%. I would guess it's probably going to be mid 20s, but the valuation is really high for Microsoft. Revenue expected to be up only 16%. In our opinion, the revenue is more indicative of what a growth rate of a technology company probably is rather than the volatility around the earnings itself. Amazon is starting to break out in terms of their earnings, so we think that there's more upside, but it's still 42 times earnings for it, and the revenue only growing in the low double digits. There's not a lot of upside left in it, but we still have an investment there and thinking that there is some upside left in that stock. Apple, no revenue growth, expected 1%, to almost 30 times earnings. This is a company that's having some problems, okay? The market's not buying into what the problems are, but it's a problem of, law of large numbers. You just can't keep growing these hand devices. They need something else. In the earnings call, the market's really going to focus on what their artificial intelligence strategy is and when it's going to be announced. If that's not coming, the stock's going to trade off. We think it's overvalued. So the stock market itself, we discussed this last week. It's now over 20 times projected earnings. Obviously, the overvaluation is in the growth names. It's in technology. It's not in the value stocks. But you need something to occur to get those value stocks moving. And that is a clear message from the Federal Reserve that they are going to cut rates. And they're going to be somewhat aggressive about it. And they're going to keep the economy growing for a longer period of time. So if they don't give that signal on Wednesday, the value stocks aren't going to do much. But if they do, there's going to be a massive rotation. You can buy the small caps and large cap value as well. The whole value sector is very attractively valued, in particular the small cap stocks. So we are looking at the Russell 2000 value ETF as a way of playing this. You can see here that off the COVID bottom, it's had a really nice move, really outperformed the overall market. But over the last, say, 3 years or so, it's gone sideways. So there's been no appreciation, traded in a range. We're starting to get up to a resistance level. If it can break through that resistance level, along with some good commentary by the Federal Reserve, we think this is a multi-year investment in these small cap value stocks. Now, the Federal Reserve meeting on Wednesday. So the market really wants a rate cut in March. I don't think it's going to happen. It maybe comes in May. I think the market would be satisfied if it did come in May. But I think the Fed is being a little more conservative, much more conservative than what the market is. I don't think the market listens to what Powell says. So on the dot plots that were released, the Federal Reserve dot plots, which is just the opinion of all the people on the Fed, it called for 3 rate cuts in 2024. So the market's expecting 5 to 6. We don't think the 3 rate cuts was really Powell's intention to have that communicated. We think it's more of a couple rate cuts at best. So we think on Wednesday, this is the opportunity for Powell to come out and tell the markets what he's really thinking. So if he's more conservative than the 3 rate cuts that were signaled back in December, then I think the market's going to sell off, provided that the market actually listens to Powell. Okay, that's a caveat we'll throw in there. So the leadership of the market, it's been primarily in technology and the technology sector itself, the communications area, which is also dominated by technology. And then, some in healthcare. Healthcare started really strong. It started to stall out a little bit. But then the cyclical areas, consumer discretion, down almost 3%. Utilities, for whatever reason, down about 3%. Materials down 3%. Real estate down 3%. To get these sectors moving, you're going to have to see some confidence that the Fed's going to cut rates and to keep the economy moving forward. The tech stocks, as I mentioned, we think they're in somewhat of a bubble mode, and that sets up a lot of risk for the overall market. So if the Fed meeting doesn't go well, we think there's significant downside in the overall market. You're looking at 10+% potential downside. I was at the Barrett-Jackson car auction over the weekend. I got to say, I had a great time. If you're a car guy, this is nirvana. This was so much fun for me to go to. And I went with the intention of buying something. And I tell you what, speaking of bubbles, like the stock market, these really high quality cars they went for prices that were just obscene. So you could buy them on cars.com cheaper than you could at the auction, which is kind of rare. This is a Corvette 1967. Beautiful car, but there's tons of them like this. It went for $1 million, if you can believe that. So there's other cars that look as good as, maybe not as good, but similar to this, that went for a lot less. But it just tells you, there's a bubble in the stock market, technology stocks, certain technology stocks. There's clearly a bubble at Barrett-Jackson, overall bubble. And so I think it's just people having, made some money in the markets and driving up the prices of these classic cars. Please hit like, subscribe, come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute where we have a lot more detail. And we'll send that to you every week. Take care.